From the morning reading, an epic buy the losers rally. The average stock is up more than 6% since equities hit their recent lows on September the 29th. But this rally has been much different than prior ones we've seen over the last year or so. That's because this time markets have been led higher by the most unloved, beaten down names, while the prior market darlings have lagged. To highlight the buy the losers trend we're seeing, we broke the S&P 500 into deciles, 10 groups of 50 stocks each, based on stock performance from the 521 all-time high for the index through the 929 low. We then calculated the average performance of the 50 stocks in each decile during the rally that we've seen since 929. And that is right here. In the chart below, Decile 1, all the way to the left, contains the 50 stocks that performed the best during the 521-929 market correction. Decile 10, all the way to the right, contains the 50 stocks in the S&P that went down the most during the 521-929 correction. As you can see, the results are as clear as day. The worse a stock did during the correction, the better it has done since September 29th. In fact, the 50 stocks in decile 10 that went down the most during the correction are up a whopping 15.4% during this bounce. Conversely, the 50 stocks that held up the best during the correction are up only 3.7% during the bounce. That's significant performance divergence. Breadth indicators turn up. Dollar weakness should start to help earnings. So should a rebound in energy and materials and a rebound in emerging markets. Upturn in emerging market currencies supports EM stock advance. Weekly MACD lines are still negative but show improvement. S&P 500 is testing resistance at its September high. The percent of stocks above the moving average line turns up. Breadth indicators continue to show marked improvement. The percent of New York Stock Exchange above the 50-day average is turning up. 2/3 of the big board stocks have cleared the 50-day lines. That's its strongest upturn this year and suggests that most New York Stock Exchange stocks have probably bottomed. Emerging markets start to improve. Another reason being offered for lower earnings is weakness in emerging markets, owing mainly to weak commodities, prospects for high interest rates in the U.S., and a stronger dollar. At the moment, all three threats have been reduced, if not reversed. As a result, we're seeing a rebound in emerging market assets. A very oversold EEM bounced off an important chart support at its 2011 low. The EEM now trading at its highest level in 2 months. Its short-term trend has turned up. It still has to clear the 200-day average to signal a major upturn. But there's a strong chance that EM stocks have bottomed. Interesting, the strongest gainers have been the commodity producers like Mexico, Brazil, and Russia. Chinese stocks are also rebounding, as are Asian stocks in South Korea and Taiwan. Analysts are still reacting to past weakness in emerging market stocks. They may have to start factoring in the possibility of future strength. The S&P 500 tested September high. Stocks have reached another important test, the S&P 500 having cleared its 50-day average. It is, however, still testing a more formidable overhead barrier at 2020. The SPX has to clear its September high to set up a more important test of its 200-day average. Its daily RSI and MACD lines are now positive. Its weekly indicators, however, carry a much more mixed message. There is some concern about the sectors leading us out of the most recent rally. It is being led by beaten down energy and resource firms. Looking at similar rallies in the past 30 years, we can see that the most beaten down sectors are almost always the ones that lead out of the bottom, and those with similar leading sectors to what we are seeing now were most often successful bottoms. Stocks have failed to respond to high short-term risk level in recent days. That doesn't say much about the short term going forward, but its longer term is a good sign. The optimism index and the risk level remain high, not giving any kind of a break for those looking for a low risk way to enter what may be a positive longer term market. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:43 a.m. Central Time, and I'm recording this in preparation for the market day of October the 12th, 2015. Full disclaimers at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive on into our overnight action, see what's coming into our morning report. Essentially, all four U.S. broad market indices are at scratch, and indeed that is not a bit surprising. Today is Columbus Day. The U.S. bond markets will be closed. The regular stock market and futures will be open, but remember, bonds are actually a much larger market than the equity market, and without that volume, we're likely to be relatively aimless today. So probably going to be a sideways, inside, directionalist, low volume day today. Obviously, anything can happen. That's no guarantee, but all things being taken into account, probably a pretty small range day. Crude oil up about 0.25%. Bonds scratch. Let's see here, and the bond futures will probably be closing here in a little bit. I don't know exactly what time that is. I should say euro scratch, bonds up marginally, and then gold up about 1%. So that's the one outlier. Now in overseas, the markets they don't care about Columbus Day. China's up over 3.25%. Hong Kong up about 1.2%. Japan up over 1.5%. Germany up about 1/3%, and the lone market that we follow that's down, United Kingdom, down about 0.5%. We do have a number of FOMC members speaking today. You got Lockhart, Evans, Bank of China speaking, governor speaking, FOMC member Brainard. You see there's a full slate of speakers. But other than that, no real macroeconomic reports for today in the United States. For tomorrow, small business index, a yellow flag report. Federal budget balance, yellow flag report. Nothing really at the beginning of this week. Now, I haven't studied the later part of this week, but I did hear reference that we've got a big slate of reports coming this week, so probably a lot more coming later this week. But Monday, Tuesday, not so much. In terms of current volatility conditions, you have short-term VIX down to a 14.27. This is really crushed of late. Skew remains high though. IV percentile 25, 18, 24, 20. So all very, very, very low. You have no standard deviation moves being put in by any of the four broad market indices on Friday. So all these conditions are very, very low, and given what we're expecting with Columbus Day today, we'll probably get another remarkably low volatility day. That's the guess, at least. So in terms of our regular daily report, we continue to see healing to the significant technical damage that was done by the August drop. IBD status, of course, is in confirmed uptrend, accumulation distribution. S&P's at a B minus, so that one's frankly pretty healthy, but Nasdaq still remains at an E. GMI index continues to improve. This is at a 4 out of 6, and is on the verge of going to a buy signal, though that author still remains in cash. Primary market condition, and looking at the key moving average relationships, that's still strong bear. You see the decision point scoreboard. Short-term indicators have all turned up, and you've got one long-term signal that has been flashed on the Nasdaq, but other than that, all the other intermediate and long-term signals are still down. So that's something of a continuing warning. Intermediate term market posture is still very bullish. And indeed, S&P, look at this, 84, very bullish, down 93.9. And then also you have Nasdaq at 69.3 and Russell at 63. So everything's at least bullish, and the most important one, the S&P, is very bullish. We'd rather see the Nasdaq and the Russell as, you know, the upper strength indicators. They continue to lag, so that continues to be, in relative terms, a warning to the persistence of this market. Hedge warning status remains level 1, yellow light. There are some elevated risk conditions, but clearly we continue to get stronger and stronger. Volatility-based metrics. You've got one here with the VIX futures being up over 18, but just barely, and that could actually go away today. You have this skew remains elevated, and that's actually signaling an 11.75% probability of a 2 standard deviation move within the next 30 days, and more often within the next few days. You have also 3 of the 5 intermarket risk aversion indicators are still flagging as risk off. So there's some warning still here in the market. Probably most notably is just from the technical standpoint, this market is right up against key resistance. I mean, almost to the penny. And you know, I love it when I hear people make comment about the market is just random. And it's like, yeah, sure. Anybody who studies charts at all sees that there is nothing random about price action at all. Obviously, you'll get noise and a certain amount of, you know, noisy signal that will tick-tock back and forth during the course of the day as the you know, individual decisions are accumulated from the many. But at the same time, when you come into these major inflection points and you see, you know, the price action of millions of traders all kind of turning at the same place, and that's a place that, you know, was predictable from days before, there's nothing random about this market. So we talked about, you know, the easy part being coming off this near double bottom to up here around this level of resistance, and it stalled there for you know, increasingly smaller candles there for about 3 days. But then on Thursday it went through this level and then predictably moved fairly quickly right up into the area of this FOMC wick. And then on Friday, look at this, doji, indecision. Bulls ran out of strength right there at the FOMC high. So we're right up against this next level of resistance. That will be the question mark now. We've got to get through 2020 to achieve the next important measure for the bulls. And until we get through that 2020, you have to kind of think that you know, we could see something a pullback, a little bit of a retracement. Nothing serious is expected at this point, but whether that happens today, probably unlikely because of the Columbus Day. Perhaps maybe tomorrow or Wednesday. At some point, we're probably going to get a little bit of a pullback, a little bit of a retrace, maybe a third of a move, and then probably resume this upward move. But we continue to run up against significant resistance. We have the 200-day moving average is up in here. And then, of course, about the 2040 area, the prior resistance from the prior range lows. So a lot of stuff still to be worked through. It's hard to believe that, you know, we're going to go straight to the moon. We've already moved about 150 points, basically in a straight move with hardly a piece of hesitation. That we get some sort of retracement would seem to be overdue. But again, short-term price action, probably nothing of note in the more intermediate term. You heard from the morning reading. There's a lot to be positive about, though at the same time you have earnings which are expected to actually not be terribly good, and you got a number of financials that are coming in this week with their earnings. So you know, that could be the spur to this retracement activity. But all in all, things are finding support and starting to move back up. Russell's been lagging somewhat. It still has yet to obtain this prior swing high and the FOMC high, so it's got more room to run to the upside. But also notice, while you had great big candles here, they started getting smaller and smaller and smaller, and this is starting to run out of momentum. Unless we get new energy, new information into the market to be able to drive that next move. Same thing here. Nasdaq, of course, had big moves here early, especially this candle here, but then in recent days has had clearly diminishing momentum, and it, again, like the Russell, hadn't even overtaken the resistance area right here, though certainly it's come close, and certainly has not yet taken the FOMC move. So remarkably lessening momentum in both of those growth areas that we need, Nasdaq and Russell, just as it's coming into obvious momentum areas. Now the Dow, of course, only 30 stocks in the Dow. It seems to be marching into its own tune right now. It has broken both to the first line in the sand and the second line in the sand with some energy, and should be and I don't know exactly the 200-day moving average. It should be right in this area. It may have even already overtaken that. Now remember, of course, the Dow being only 30 stocks, I mean, this could be being powered by a minority of those stocks, or it could be very much that just the defensive nature, big cap, dividend paying stops that the many of the Dow Jones stocks are. That's where a lot of money has been rotating, and we talked about that last week. So that may be what's going on here as well. So are we now within the prior range? Well, the prior range would probably be drawn, let's see here. I would probably draw the prior range as something about around here. Obviously the upper parts here, the lower parts around here, and we had the undercut, and then the back move towards the top of the range, and then that then fell. So probably the next line of resistance here for the Dow is probably this area here, about 175. So there's pretty good amount of space here for the Dow index to be able to run through some clear area. So this one could be off and running, and only weighted down by the other three indices. Let's take a look at the VIX futures. We look for this to start to break down and hold below this area, and certainly it's starting to look like that. I'd like to see a more pronounced move down into this area, but certainly it continues to weaken. Today probably being a low volatility day, this will probably continue to ebb down a little bit more. We're certainly down below 20 now, and starting to get into that area where we call it, kind of in quotes, normal bull market volatility in that 12 to 18 region. It's right on the verge of doing that. Okay. In terms of special opinions, option income strategies have VIXs just barely outside the acceptable window for novice traders to initiate option income strategies. Aggressive traders can leverage the higher premiums, but consider reduced position size and potential for higher than normal delta and vega moves. In general, much of our warning here is probably just about passe and probably should be lessened. And indeed, novice traders, you might even want to take reduced position size and look to start initiating option income strategies. So this seems to be quite a bit lessened from what we've experienced in recent weeks. In covered call strategies, conditions are cautiously bullish, acceptable to initiate new positions, especially for novice traders. Think about a 1-to-1 ratio of in the money and out of the money strikes. Also, in this kind of defensive posture market, think about a 1-to-1 ratio between higher beta and lower beta positions. Initiate positions while maintaining a defensive posture until the market begins to establish a stronger, more holistic bullish environment. Consider reduced position size or legging into covered calls through well out of the money put selling. And also, as always, keep that position size in the scale you are willing to own if you do leg in through puts. And indeed, on put selling, cautiously bullish, conditions seem fine. Consider defined risk positions, spread those trades off, by using bull put spreads, and then aggressive traders consider scaling into full size positions. In terms of the relative rotation graph, we see, several of these industry groups or sectors continue to look pretty good. IYR, that's one that I have as a position in my core portfolio right now. And you're certainly in the right sector. I'd love for this to be pushing up, but certainly it's in the right place. It's been performing well for a number of weeks. XLU, same thing, in the right sector. You'd love for it to be heading up and to the right, but at least it's in the right sector, though it seems to have been tailing off a little bit of late. The same thing with IATB, which is home construction. So very, very defensive kinds of moves here by and large. In terms of sector specific, much like Friday, a lot of green in the short and intermediate. Continue to see improvement here. In terms of sectors percent change, we had, remember, kind of a doji-like body on most of the indices on Friday, and as much as you would expect, pretty mixed across the sectors here. Certainly a lot better seen here in terms of 5-day, 1 month, 3 month, even year to date. We're starting to see some improvement, while ultimately the S&P is negative still for the year to date, down over 2%. And here we are, middle of October, so it's not been a great year for the bulls. We're starting to see, at least in the shorter term, a significant amount of improvement across a significant number of sectors. So that should take care of us for today. As always, if you find what we're doing is helpful to your trading, like us on YouTube. We take note of every single one of those subscriptions. Greatly appreciate when you subscribe to our YouTube channel. That, of course, allows you to know when we also post these videos. We, of course, will also post to Twitter and StockTwits and Scootify and Facebook. If you're on Twitter, retweet us to your Twitter followers. The same thing for StockTwits. All those measures show appreciation for the work that we're doing, and that's in fact how we get paid, by your appreciation, and we very much appreciate you. Disclaimers as always. Hit the pause button if you need more time to review this. And that should be more than enough for today. A bit long, but we had a lot of material from the morning reading from over the weekend. Should be an interesting week as earnings get started in earnest. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.